Welcome to Voice Podcast. Today we're going to talk about some financial matters and about market inefficiencies. So, as you know, there are those old market theories, academic theories, that say that it's a hypothesis of efficient markets. That means that markets, every participant is rational, they make only good decisions, they understand and have all the information that is available at the market. And this hypothesis says that because of that, because of the high rationality, etc., all the prices in the market are effective and there are no anomalies in the pricing. So if something is worth $100, you cannot buy it way below that price. And this is of course not true. And today we are going to be looking at the mechanism that create market inefficiencies. So if you are looking to buy something, maybe invest in something, if you can find some anomalies, some market inefficiency, then you can buy that way below the real value and make a nice profit on that. And yeah, we'll today unmask the markets and peel back the layers of financial system and expose both the brilliance and cracks beneath the surface. We'll be talking about structural flaws in market mechanisms. So there are different reasons why markets are mispricing some of the assets. One of the reasons is behavioral, psychological, and today we are going to be talking about different reasons that come from how the stock market is structured, how the mechanism work, and how in certain cases the structural flaws in market mechanism can create mispricing opportunities. So in modern world, financial markets are often celebrated as the backbone of developed economies. They are where companies raise capital, they are where individuals invest for retirement, for wealth, for security. Ideally, these markets should reward the best businesses, the ones that are well managed, offer valuable products and show promising growth. But what happens when the system doesn't work the way it should? Let's take a closer look at the problem of market inefficiency. So efficient markets are supposed to funnel capital into great companies, but inefficiencies, they flip that idea on its head. When markets misfire, bad companies can still raise capital, investors can get pulled into overpriced hype, and sometimes bubbles form. And when those bubbles pop, the fallout can be devastating. So what really causes those inefficiencies? Let's start with one of the biggest culprits, and that is information asymmetry. Now we all have access to the internet, company reports, news, updates, economic indicators, etc. But here's the truth. Not all information is created equal and not all investors are on equal footing. For instance, institutional investors, think hedge funds, large banks, asset managers, they have an edge. They use elite human capital, better data, and incredibly complex mathematical models to make lightning fast decisions. They also have algorithms and robo-advisors that can analyze markets and place trades in milliseconds, so way faster than any human ever could. Those top algorithms and robo-advisors that are basically algorithms that make decisions, buy and sell financial instruments. They are programmed with special low-level languages that make them super quick. So even if you create your own program, it won't be able to be as fast as the low-level languages, programs used by some of the institutional short-term speculators, traders, all of this algo trading, etc. So there's this huge increase in data processing because those algorithms can take countless millions of data in a second and analyze it and take a quick millisecond decision based on that. For instance, there is this fund Renaissance Technologies. This legendary fund powered by robot trading delivered an eye-watering 66% annualized return before fees from 1988 to 2018. So as you can see, using this algorithm trading, somebody got a return of 66% per year. So that is 6 times more than the market average for the S&P 500, more than 6 times. So it's a huge return, but they are on the forefront of algo trading as they connected their financial institutions and the financial people with people from physics, and they developed those very complicated physics models and use them to look at countless thousands different factors from the economy and make decisions based on that. So it's like a huge intertwined model where changing one aspect can change different aspects of the model. It's quite complicated. It's quite new technology, but it works really well. So it's not just luck, it's also tech, math, physics, and billions of dollars to create the infrastructure. And for retail investors, they're often left in the dust. Not only do they lack those tools, they're also bombarded by misinformation. From biased media to misleading financial advice, the average investor is often fighting an uphill battle. So usually when I see somebody who is not interested or doesn't actively invest on the stock market, when they want to buy something, they are often driven by the hype on in the media. So they usually want to invest in some financial bubbles. They like investing in Bitcoin when the price is high. They like investing in Nvidia when price is high. So they are acting opposite to the fundamental idea of buy low, sell high. They like hype, and the media talks about some, Bitcoin going to 100k, Nvidia going to few hundred, and they get greedy and want to go in and buy into those bubbles. And of course, let's not forget 2008, Goldman Sachs advised clients to invest in toxic mortgage-backed securities, all while betting against them. And Lehman Brothers sold worthless products right up until its collapse. So the consequence of that were massive losses for everyone else. So sometimes even your financial advisor can sell you something, some bank can sell you something that they know is not good for you, and yet to make a profit they will still sell it to you. So the information asymmetry is a big issue. Well, when the retail traders not only don't have access to good information, but they also are affected by a lot of misinformation and fake news. And it is very difficult to even find some good investing strategies or financial information. You can look at what the richest people are buying, because there is a law that called 13F filings. Every quarter they need to report what they bought, what they sold. So you can look at what Warren Buffett is doing. You can see what Bill Gates, Jeff Bezos, Elon Musk, all of those great business people and investors are buying on the stock market. So there is access to information, but you need to know how to find it. You can find it on websites like Dataroma or Stock Circle. But for financial reports, you can always look at the company's website, or another free one is Yahoo Finance. For looking at price charts, TradingView is free and it's quite good. So there is information to find even if you don't have a lot of money, but it's still difficult to compare information sources. For instance, I'm using GuruFocus. I think the cheapest subscription is around $1,000. So the information there, how it's presented, just makes it a lot easier. And for Polish companies, I can recommend Business Radar. It's really good. And another topic is about access to the instruments. So while it's true that anyone with a brokerage account can buy shares in big public companies, access to smaller or foreign firms, that's a different story. So if you are from a third world country, if your bank is small, if your broker is not a big broker, there can be a limit to what companies you can buy. For instance, if I am from Poland, then I can buy through my broker account some small companies from the Polish market. But for investors from China or USA, they won't be able to find those small stock market companies in their bank or brokerage firm. It of course depends how big you are, because if you are some big institutional investor, then you have access to everything. But there are still limitations on the big institutional investor, and that is the size of the company. They are usually forbidden to invest in anything that is under a couple of $1 billion in market cap. So they have so much money in the bank, in their investment fund or whatever, that they cannot really look at a company that has a market cap of less than $1 billion, because they won't be able to invest even a small percentage of their money into that. So there is no need to waste time looking into a company that they know is too small for them to invest in. And that gives us retail investors, people who have less money, chance to look into those smaller companies and invest our capital there. And without the competition from the big banks, this can be a better place to look for undervalued stocks. So Warren Buffett and Peter Lynch, all other value investors, say that it's much easier to find undervaluation in small obscure companies where the Wall Street is just not looking. And there is also issue of geographic restrictions. For instance, if you want to invest in a Chinese tech company like Alibaba, as a non-Chinese investor, you can't actually buy the real company. Instead, you are buying shares in a holding company with complex, risky contractual rights. So what does it mean? That not everything can be invested in. For instance, Alibaba, if you want to buy Alibaba, you are not buying Alibaba as a Chinese investor would, but you are buying a CDR. It's like a contract that represents like Alibaba. The price of that instrument changes as the stock price of Alibaba changes, but still it's not the stock itself. It's a complicated matter, but another easier example, for instance, if you are from Europe and you want to invest in Russia, you can't. Because of the war, they closed the stock market and you cannot invest there. If you had some Russian stocks, you cannot close them, you cannot sell them. So the geographic restriction is also a big problem. If you want to buy some small Chinese company, maybe it's very cheap, well, probably your broker doesn't have it. If you are from Europe or USA, then it's difficult. And another cause of mispricing is transaction cost. This is very easy to understand. Let's say that the real value of the company is 105, and right now the stock price is at 100. So the real value is $5 above the current price. So maybe somebody would like to buy it because it's a very small undervaluation. But because of the transaction cost, if you need to pay a few dollars just to get in, then it doesn't matter. The mispricing needs to be significant that after transaction cost you still get a cheap bargain price on that security. So yeah, and stock prices are driven by supply and demand, and that can also be impacted by transaction cost. If something has very high transaction cost or high swaps, whatever, then people aren't so willing to buy into that. And there can also be this illusion of efficiency, where according to efficient market hypothesis, asset prices reflect all available information, but the reality paints a different picture. So institutional investors dominate certain market segments and ignore others entirely. So for instance, they invest in big companies but not into very small ones. Retail investors face manipulation, misinformation, limited tools. There are some trade restrictions, political events that block access, like the war in Ukraine, and of course the information asymmetry. Even IPOs, supposedly timed for company needs, are often launched during bullish periods when companies can cash in over optimistic valuations. So IPOs, when company goes public, when they want to list for the first time on the stock market their shares, They usually do it during bull markets when everybody is optimistic. They can sell their shares for the highest prices. And another cause of mispricing is the transaction ladder mispricing mechanism. So what does it mean? When a lot of people are selling or buying its stock at the same time, there can be a huge change in price in a short term. So for instance, if the stock is at 100, there are investors who have buy orders at 95, 98, around that price, right? So if the current price of $100 drops to 98, there are more orders that are ready to be filled and people are buying at the lower prices. The same goes at 95, etc. But if the current price of the stock is $100, nobody is going to place a buy limit at, let's say, $10 or $50, because that money gets frozen. So let's say they want to invest $1 million at the price of 50, but the current price is 100. So that money, if they put an order, will be frozen and will be waiting, maybe even for years. Maybe the price will never drop from 100 to 50 to realize that order, and that money is frozen. It's not working for you. So they don't want to do that. Nobody will open an order that will wait for days or months and maybe never will be fulfilled. So all of the orders are next to the current price, maybe at 98, 95, 90, but not like 50% below the current price. So what happens when there is some news or something that changes the investor's sentiment and a lot of people start selling? First, there are buy orders at 98, there are buy orders at 95, there are buy orders, so they can sell their stock to those people. Then the price drops lower and lower. But what happens when the price goes to 90, to 80, to 70? There are no buy orders. There is nobody waiting to buy. Although the price is super cheap, maybe at $50, everybody would like to buy it, but nobody froze their money, nobody looked at the stock today, and there are no buy orders. So what happens when people are pressured to sell, maybe because of this negative news? Then the price drops, and at some point there are no orders. So this price drop starts to get faster and faster. The price starts to drop more dramatically as there are no orders. So the seller, they are looking for the order, and this is decreasing the price. Where are the orders? There are no orders. So that creates a stock market crash. So when there are high volumes of trades in one direction in a close period of time, then that can lead to transaction ladder mispricing mechanism, when large one-sided trade volumes create a stock market crash, for instance. All right, and I think those are the main structural flaws in market efficiencies. Another podcast will talk about behavioral, so like psychological biases that cause market imperfections. There are more than them, but it's also important to understand and know a little bit about the structural flaws in market mechanism because stock market is like an auction. Sometimes the mispricing can occur because of the flaws in information asymmetry, in access to information, in how quickly you can analyze that information, so through algorithms, etc. Transaction costs are also a big issue, and some geopolitical tensions, and depending on where you live also you have different access to instruments. So if you're a small retail investor, remember that there are anomalies, there is a lot of mispricing in the market, and it is the easiest to find it among smaller companies where the big institutions don't look. Okay. Thank you for listening to today's podcast. I hope it was nice that you learned something, and I wish you a great week. See you later.